Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Welcome back to the Ask Ralph Show. The other day I got a phone call, and this is a common phone call that I get, and my client basically wanted to know if there was any benefit in them investing in a Roth IRA. And then we got into it a little bit more detailed discussion, and he mentioned that his employer at work actually started a 401k Roth plan as well. So I thought this was a good topic to talk about today. So I wanted to talk a little bit about the basics of the IRA, the traditional IRA versus the Roth IRA, and then talk a little bit about the nuances of this new Roth 401k. So really, from a very, top level decision point, the big difference between a traditional IRA and the Roth IRA is, when do you get taxed? So let me explain that. With a traditional IRA, when you make that contribution, that is a deduction on your tax return in the year that you make that contribution. So if you put $5,000 into a traditional IRA, that will reduce your income in the year that you make that contribution, therefore saving you on taxes. Now, with the Roth IRA, the Roth IRAs are funded with what's called after-tax money. And the reason that they're funded with after-tax money is because when you go to take the money out of the Roth, assuming you meet the minimum requirements, and we'll talk about those in a few minutes, all of the income from the Roth IRA is tax-free. So basically, it becomes tax-free income in retirement. So what's the benefit? Well, basically, and this is something I've had to evolve with too, because I was really not a big proponent of the Roth IRAs when I first started in practice. But now I've come to understand why they might be useful as an investment tool or as an addition to your investment portfolio. Now, the way that the Roth benefits you, and this is a great example. Let's say that you're just starting out in the workforce and you're putting money into a traditional 401k or traditional IRA plan. The problem with that right now is that you're probably in a lower tax bracket than you will be in later. Now, I have found in my own practice that most of my clients, now I'm probably biased because most of my clients have assets and have more complicated tax returns and that sort of thing. But most of my clients have as much or more income in retirement. So the old adage of, well, let me put this money away into the traditional IRA or traditional 401k, and then when I retire, I'll be in a lower tax bracket. So when I go to take that money out, it won't have as much of a tax impact. The problem is, in practice, what I have seen is that doesn't always happen. And frankly, more and more, I'm seeing more people with income in retirement, which is at or greater than their income when they were working. So this Roth IRA can be a really good option for that, because it basically will be something that you can take money out of in retirement, but you won't have to pay any tax on the income that it earns. Now, if you have to take the money out before 59 and a half, you may have to pay some tax depending upon whether you break into the income portion or you just take the contribution money out. So a lot of people will call this sort of a flexible emergency savings account. So that's another use for that. The other benefit to the Roth IRA is that if you want to continue to contribute after age 70 and a half. With traditional IRA or traditional 401k, you have to start taking what's called the required minimum distribution when you reach 70 and a half years old. With the Roth IRA, you don't have to do that. So there may be some efficacy for some of my clients or some of you who are listening for why this would be a benefit. Now, the latest nuance to this, and this is what this client called me about the other day, was his employer is now offering what's called a Roth 401k. So in addition to the normal 401k, there's this Roth option. Now, what's the difference between the Roth IRA and the Roth 401k? Well, quite frankly, the big difference is the Roth 401k is a employer-sponsored program. The other benefit to it is the contribution limits are the same as a traditional 401k. So whereas the Roth IRA may only have a $5,000 contribution limit, and the other issue with the Roth IRA, and I don't want to get too lost in the details, is that it's also income based. The 401k Roth version is not income based, and the limit is still, for example, it's $18,000 this year, and if you're over 50, an additional $6,000. So what's the efficacy in using the Roth 401k? Well, the big one is you're putting money away now, and it's after tax money. So it's already been taxed. So when you go to take this money out, there's not going to be any tax hit. So if you feel like I do that taxes are going to continue to go up, and who knows what's going to happen with that, there's some uncertainty. You can use these Roth 401ks to help build some retirement income, which is not going to be taxable to you. So that's one of the benefits. And this all comes down to a very big discussion about what do you expect taxes are going to do. The old adage is, I'm going to put away the money today because, when I go to retire, I'm going to have less income, and which means I'm going to be in a lower income tax bracket. So that's been the big hit for why everybody says, you need to invest in the traditional 401k or the traditional IRA. But I'm really thinking now, I've got to change my perspective on this. And I don't know that you should put all of your eggs in the Roth 401k or the Roth IRA, but I think it definitely makes sense to put a blend of those into that type of thing, because it does give you huge flexibility and what they call tax diversification. So just something else to consider. Now, there are a couple things that you need to know about the Roth IRAs. Now, this is not the Roth 401k, but this is more the Roth IRA. If you need to take the money out before you're 59 and a half, and this is why they call it the emergency savings account, there are some qualifications you can do. The first one is for a first-time home purchase. You can take up to $10,000. Another one is post-secondary education. There are some other circumstances as well. For example, if you are permanently disabled, if you have unreimbursed medical expenses that exceed 10% of your adjusted gross income, if you owe back taxes, or if you're paying health insurance premiums when unemployed. So there really are some benefits to the Roth and to the Roth 401k. And, I think there's going to be a lot more employers starting to offer this. It's an additional thing for the employers to pay for, because it has to be treated separately and it has to be maintained in separate record keeping. But it is definitely a good option if you feel like your retirement income is going to be at or near your working income, and if you feel like taxes are going to continue to increase in the future.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware, and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.